Hello, today I'm going to be going through a question on partnership financial statements. So what I have for you is on the right hand side is a question where you have a trial balance. Okay, so we've got a trial balance on the right hand side. Typical income, expenses, assets and liabilities. We have some information about capital and current to do with partners. We've got two partners, Clark and Pierce. Okay. Now, for this question, I'll try and squeeze it all in if you wanted to do a screenshot so you can have a go at it yourself. If you just bear with me for a moment. There are some notes at the bottom to do with depreciation, partnership salary, interest on capital, and information about how profits and losses are going to be shared. Okay, so it seems like a relatively straightforward financial statement question. The tasks are at the bottom. Okay, so there are two tasks. The first task is you need to put together the capital accounts for the two partners, the current accounts for the two partners. Okay, and then task two is, once that moves away, is the partnership financial statements. Okay, before you start, what I would probably do is, again, if you know the capital account in this question is going to stay the same, it's not going to change at all. Okay, so you can do that at any point. The current accounts, if you remember what comes into current accounts, okay, you can only put together a current account once you've drafted the income statement and you know what the profit is and you know what comes through appropriation. Okay, so before you start this question, my advice would be do this in order, and that's what they've mentioned here. Okay, in order to complete these, you will need to calculate the profit share from the statement of profit and loss in task 2. So I would probably just ignore that, and if you're listening to this at this particular point, the structure I would do is the income statement first. I would then do the financial position, not all of it, but most of it till the finance by section. So the whole of the income statement, do all of the FP except for the last section, finance by. Now before you do that, I would then do the capital and current account. Once you have those figures, then you can finish the last section off. So that's the format that I am going to be doing this question in. Okay, so I will try and squeeze everything in. If you could just remember capital, current, and both statements, income statement and FP, I'll try and squeeze all the information in if you were going to take a screenshot. So I don't know how clear it's going to be for you, but you may want to. So Clark and Pierce are the two individuals, 30th June 2014-4. I think if I just leave it there, you could probably take a picture or do a screenshot at this particular moment. You've got all the information there for the trial balance. Okay, and you may want to take another screenshot now where you've got the notes and the tasks. Okay, so let's start this question. So as I mentioned, what I will be doing is I'm probably going to have to, I could leave that like that. I can probably scroll up and I have all the information that I need just there. Okay, so I am going to be getting started with the income statement. Now this is, you can tell from the title, it is not a recent, it's not a recent question. It is a slightly out of date in terms of the title. For AQA, they would want you to call it perhaps Clark and Pierce in partnership statement of comprehensive income. So For those of you that are following the new AQA specification 7127, which is the 2017 spec, then the title would need to be Clark and Pierce in partnership, statement of comprehensive income, and then for the year ended 30th June. Okay, -4. This is just from a different examining board, and for some reason why they just like to put in hyphen. I don't know why that is, but it is what it is. Okay, just remember, when it comes to our title, there are three things. There is the name or company. There is the statement type. Sorry, four things: name, statement type, for the year ended, and the date. Okay, the financial position will not be for the year ended. The financial position will be as at. Okay, so there are four things to know when it comes to a title. Okay, so again, for me, I just need to remember that there is depreciation. Okay, that's something I need to remember for the income statement. So hopefully I'll remember to cover that off. Okay, the rest of it, everything else is on the right hand side, so we can pretty much start the question now. So let's get started. So we're going to use two columns. Again, every category of the income statement you can perhaps switch, okay, or feel free to use the right hand side for key headings like sales, cost of sales, gross profit, and total expenses, etc. Okay, and on the left hand side for workings if you perhaps want to do that. But we have sales revenue. That's the first part to any income statement. Okay, sales revenue. Then you have cost of sales. Now in this question, you've got sales revenue at the top. Cost of sales is right at the top there. They've given it to you. You don't have to work it out. Normally, cost of sales will be opening inventory plus purchases, perhaps minus purchase returns, and typically minus closing stock. You may have carriage in there as well. You may have an adjustment for drawings. Okay, but we're going to keep it nice and easy, nice and simple. Again, the objective of this particular video is you are able to draft an income statement, an FP, with current accounts and capital accounts. Okay, so we have sales and cost of sales there. That leaves us with gross profit of 105. Then we have expenses. We don't have any forms of additional income in the question, so we're going to move straight on to expenses. So we have payroll, and I'm assuming we're going to go in order of these. So pretty much all of these are your key expenses there. Okay, so we have payroll, electricity, telephone, rent and rates, which is over there, discounts allowed, and office expenses. Okay, so there are no accruals or prepayments or anything like that in this question. Okay, which does make it quite simple. There are some other expenses that I can see: irrecoverable debts, which is the next one, and depreciation, which we need to remember. And just going on the depreciation note, they mentioned 20% straight line. Okay, 20% straight line, which is on 52,000. Okay, 20% on cost. Again, your two depreciation methods: straight line is on cost, and reducing balance method is when you take accumulated away from cost, which is net book value or carrying value, and then you do the percentage on that. Okay, nice and easy straight line method on cost. So the 5%, I think it was. Sorry, 20%. 20% on cost. Okay. Let's scroll back up. Okay, so there we have all of our expenses. Total expenses 68 to 80. And just scrolling down. Profit for the year 36,720. Okay, so if I just leave that there for a moment, we have sales minus cost of sales gives us gross profit. We have all of our expenses, take them away, total expenses away from gross profit. So 105 minus 68 gives us the 36,720, and that is your profit for the year. Okay, so it is a nice straightforward question there. Okay, I'm going to just pause there for a second if you want to take a picture or screenshot at this particular point and check what you've done so far. Okay, moving on. So again, what needs to come after this, the difference between a sole trader and partnership, is that a sole trader would end here and then you would move on to the FP. However, for a partnership, you have the additional section of appropriation. And that's what we're going to do now, and try and remember what comes into appropriation. Okay. Now, from what I remember, what comes into appropriation is interest on capital, interest on drawings, and salaries. Okay, those three things. Instead of salaries, you may have commission. So interest on capital, interest on drawings, and salaries. Salaries we know affects profit. Interest on capital is a cost to the business. It will affect profit. And interest on drawings will affect profit in a favourable way. Okay. Salaries, profit comes down. Interest on capital, profit comes down. Interest on drawings, profit will go up. Okay. Remember, drawings, if an owner takes money out of the business, it shouldn't affect profit. It does not affect profit. Okay, just because someone's taken £10,000 or £15,000 out of the business, it doesn't mean profit changes. Profit is income and expenses. Please, please, please do not put drawings in to the income statement. It is not an expense. Okay, it is not an expense. Okay, let's have a look at appropriation. Oops, not sure what's happened there. I may have done appropriation on another tab. Yes, I have. Okay, so let's just realign, making sure I can see everything. Okay, before we start that, just going to have a quick look at the notes. Again, I can't squeeze everything in. However, Pierce is going to receive a salary of 12. Okay, so something to remember there. We've got 3,000 and 1,500 in terms of interest on capital, and then 2/3 and 1/3. Now I think that's vital information. So what I may do is scroll down and leave that up there, because the rest of the information, all of our expenses, etc., that's here, we don't need that. We've dealt with that. So what I will do is I'm going to just leave it there. Okay, so appropriation. And I think this was covered in part 1 of partnerships. We've got profit for the year, okay, which stays the same. You deal with your adjustments, and then you have your profit available for distribution. So we've got profit for the year. That is continuing from before. Okay. So salary of 12,000 is going to reduce profit. Pierce gets a salary, the other person does not. And the other person is Clark. Okay, so Clark doesn't. Salary has come from the notes at the bottom there. Then we have interest on capital. Now, what they have done is, in the question they've said 5%, but they've worked it out for us. Okay, so Clark has 60k and Pierce has 30k. They both get 5% for 12 months. Okay. However, if you were to do 60 at 5% and 30 at 5%, you'll come up with the same figures. So in this question, they've just given it to you. AQA in reality will make you work it out. Okay. So like I said, this is an intro into this particular topic. figures are given to us, we can put them straight in. Okay, and remember, salary is going to be deducted. Preferably, I would put that into I'd put that in brackets. Interest and capital also, I would prefer that if that was in brackets. Okay, I don't think AQA are going to be that particular if you do or not. However, obviously, when it comes to you doing the final figure, if you don't see a brackets there, you might just add it on. Okay, and that's going to be a fatal error. So remember, we said there's three things that go into appropriation: salary, interest and capital, interest on drawings. There is no interest on drawings in this particular question. So if we 36 minus 12 minus 4.5 gives us just over £20,000, and then we are going to split that. Okay, we're going to share that between Clark and Pierce, 2/3 and 1/3. Okay, and hopefully that will disappear so you can see that a bit more clear. So Clark gets 2/3 and Pierce gets 1/3. Okay, so that is your split, and then we always add them back up together. So we've got profit for the year less appropriation. Profit available, this is actually what's going to be distributed between these two, and that's your total profit distributed. You may see slightly different subheadings in other questions, and I think as we go through maybe more AQA style questions, you can pick something that's suitable. Obviously, for AQA, titles are important. Okay, subheadings are important. With QWC marks in the new specification, you know, they will award, for example, 1 mark if you get the final profit figure. However, it would need to be labelled, as well as this would need to be labelled, as well as profit for the year, as well as you having a label for cost of sales and gross profit, etc., etc. So labelling is really, really important. Anyway, accuracy of detail is important. However, AQA, with the new spec, they have become really, really tight with just giving marks away. Okay, so you really have to do everything perfectly. No shortcuts to get these QWC marks. Okay, so in summary, so far what we've done is the income statement, and then we've moved on to the appropriation section, which is part 2 of the income statement there. Okay, the next step, as I mentioned, income statement first, appropriation second, then the FP. We'll do most of it. We'll stop at the last section, finance by. We'll do the capital and current, and then we'll finish the FP off. Okay, so let's move on to part 3. Okay, so financial position. Again, I'm just going to put the PDF at a point where I think I need it most. So we've dealt with all of this, so I don't really need that. So what I'm going to do is just try and see everything that I can. I think that's going to be okay. Okay, so we have the title, 4 things. Number 1, the individual or company. Number 2, the type of statement, statement of financial position. Number 3, the ASAT, or for the year ended. ASAT is for the FP, because remember, the income statement is profit. The whole purpose of an income statement is to work out profit for the whole year, whereas the financial position is a picture of the company books as at, i.e. on a particular date. Okay, so the income statement shows profit for the year, whereas the financial position is a snapshot of a business's assets and liabilities on a particular day, and as that's what it refers to, on this day. Okay, on this day, and then we have the date, which is number 4. Number 1, number 2, statement type, number 3, as at, and number 4, the date. Okay, and again, FP needs to be put together in 3 columns. Okay, so first section is non-current assets, which we have only one from what I can see. Office equipment at cost, we've got depreciation. Okay, now 52 is our cost. Depreciation, this has come from the 2800, this is from the previous year, and if you go back to the income statement, we put in 10,400. Okay, you may recall that, and I might just have to refer to it here, which is that one over there. Okay, so what goes into the FP is 52 at cost, 20,800 plus the current year's depreciation becomes your accumulated. Okay, let's go back to that. Okay, 52 minus 31,200, which came from 52 minus 2,800 minus the current year, which is 10,400, gives us 20,800 left. Okay, it just so happens that that is the same figure as that, so don't be confused. This is not that. Okay, hopefully you know your depreciation well. So there we are, the first category for non-current assets. Second category is current assets, and I've just put those three in together. We've got closing inventory, which is there, 41,570. The second is trade receivables, and I think in the previous video I didn't refer back to allowance for doubtful debt, so I'm going to make that clear here. And again, this is something that you should know. Sales ledger control, this is what customers owe us. They owe us £20,000. However, we have made a provision that some customers, we have estimated that some customers may not pay. Okay, and if you have allowance for doubtful debts, it must be taken off the total debt that's owed to us. So customers owe 20,000 to us. However, we've done a calculation, an estimate that £780 we may not receive, and therefore the difference, 20,000 minus 780, is what a more true and fair view picture of what is going to be received. Okay, again, this is something that you should know at this particular point. Okay, on that note, oh, go away. On that note, irrecoverable debts, which is here, this is already in the trial balance. Okay, you don't need to worry about taking that off. A lot of students, what they do is they see irrecoverable debts and they take it off SLC. The reason why we're not taking this off is because it has already gone through the books. Okay, so we have already credited the SLC, we've reduced it, and we've increased the expenses. That's how that got there in the first place. Okay, 1,200 appeared here. How? Because SLC was credited and irrecoverable debts was debited. So we don't have to worry about the 1,200. All you've got to do is very simple, SLC minus allowance for doubtful debts. Okay, which is that figure there. Then you have your bank. Your bank is at the bottom. It is a debit balance. It is a positive. It is an asset. And you add your assets up. Okay, so that is the second section, current assets. Section number 3 will be our current liabilities. Again, I'll put them all in together. So we have two. We have trade payables, which is purchase ledger control. This is a liability. It is a credit balance. And we have VAT, which is not tested in AQA. However, we know it's a liability because it has a credit balance. Okay, so don't worry about that for AQA. And then we have the total, 12,190. So you've got your current liabilities there. Okay. The next section, again, something that you should know, is your net current assets. The difference between your current, okay, not non-current, current, this and this. So let's have a look. 82 minus 12 is 70. Okay, 7350. This is basically what the business has in the short term in terms of their liquidity. Okay, short term cash equivalents. Now, what would normally go next is your opposite to this, which is your non-current liabilities. However, in this question, I can't seem to find any, so I don't think there are going to be any. Okay, feel free to write down non-current liabilities if you wish. Otherwise, it's going to be net assets. Okay, so again, you feel free to write it in if you want. This particular mark scheme has gone straight in for net assets. Okay, and as you may know already, net assets is all assets minus all liabilities. So there's two ways of doing it. You can either do assets plus assets minus liabilities, or you can use the 7350 plus that. Because remember, this is that minus that equals that. And if you add that on, equals that. Okay, so think about it. 70 plus 20 is about 91, right? And if you do that minus that, it gives you that. And then you can just add that on top. So you can either do, sorry, let me repeat that. Assets, 20 plus 80 is 100. Minus 12 is roughly 90. So you can either do that plus that minus that, or net current assets plus non-current assets. There's two ways of doing this. Okay, I'm sure by now you know which method is more preferred for you. Okay, so we've done net assets. Now, from what I remember, I mentioned we will pause at this particular point in terms of continuing with the financial position. What we'll do now is we'll look at the capital and current account. Let's get those drafted, and then we can move on to finishing this off. Okay, there's no point doing the next section because the finance by section you need capital and current. However, the current account needs to be changed, it needs to be updated, so we need to do that first. Okay, and you'll know what I mean once we start the question. Okay, so again, if you want to have a go, feel free to pause the video and have a go at the capital and current. I've got a template there already for me that's done. In actual fact, the capitals are actually done, and the reason why is there's no changes to it, so it is just a normal capital account. There's no changes there, so I've left that as it is just to save time. The current account, you've got a template there. Feel free to pause and have a go yourself. Otherwise, I'm going to get started with it now. Okay, so we've got the current account, 2-column T account for the two partners. Okay, now remember in here, these are all figures readily available for statements. However, these are not. So the current account here and the current account for Pierce, Clark and Pierce, they are not ready. We need to use the balances. Okay, we need to consider the salary, the interest and capital, and the 2/3, 1/3 profit share. Okay, and take all of that information and put it into here. So let's have a look. We've got 430 and 300. 430, 300, opening balances. Next is the salary, which we have at the bottom there. So we're expecting 12 for Pierce only. Sorry, I think I've done drawings fast. Okay. And I'm just trying to look for this figure. There we are. So we've got drawings there that go into the current account. So we have Opening balances, we've got drawings, which reduce the balances. Again, just a quick recap, just for clarification. You have capital accounts, they don't necessarily change. Okay, the balances in there will always generally remain the same. Okay, when it comes to partnership, something that AQA will expect you to know is what changes a partner's capital account. And a video that I will be doing in the next couple of days will be on capital accounts and the changes to capital. In actual fact, I think that's the next video I'm going to be putting together, okay, which is part of partnership accounts. So for now, just assume capital accounts, there are no changes other than the additional injection of capital. So normally capital will be a credit balance. It will generally stay the same unless a partner decides to put further capital in permanently, or permanent withdrawal of cash. Okay, so for now, for this particular question, let's just make it simple. There are no changes with capital. However, a quick recap on current accounts is you have your increase on the credit side, increase, and your decrease on the debit side. Anything coming on the credit side is a positive. It is a benefit to that partner, and anything on the debit side is a drawback or a cost to that partner. Okay, and we can see from the populated information here, a salary is a positive. Who wouldn't want money? Interest on capital is a reward for keeping your money in the business. Profit is great. Drawings reduces the level of investment. Okay, obviously drawings, a partner wants cash, it's good for them, they're taking money out of the business, but from a personal perspective it's good. For the business's perspective, it is not so great, and from their investment perspective, it is not great. If they start taking cash out, the level of their investment is reduced. Okay. So we have, let's get back to the question. We've got opening balances, drawings, which come from here, and then we have the salary, which is at the bottom, okay, in the note section. We've got interest and capital calculated for us already, 3 and 1.5, and then we have the profit share. So if I just go back to this, 13,480 and 6,740, they will come in to here. Let's have a look. There we are. And then we total up the debit side and the credit side. So 2,600, take it across to the other side, and difference above. Okay, and one more. There we are. Okay, so 20,600 total, take it across, difference above. Looking at Pierce, this side looks there to be more, so we add up 2540, take it across, difference above. This is your carry down for Pierce, and this is your carry down for Clark, and their respective balance brought downs should appear. There we are. Okay, so you've got carry down, brought down, carry down, brought down. Now looking at this, you obviously would have identified one has a credit balance and one has a debit balance. And what that basically means is Pierce has a positive, so the partnership owes him, and Clark has a negative, where he owes the partnership. Okay, so Pierce has been good, and he has left a bit of money in the business, whereas Clark has taken out. Think about it. Look at Clark. Okay, he's started off with 430. He's had some interest in capital. He's had a bit of profit share, and he decided to sorry, yeah, he had an opening balance, interest and capital, profit share. So he's got about 17,000 for himself, right? What does he decide to do? Decides to take out £20,000 for himself. Of course, he's going to end up with a -3. Okay, if he had about 17 to himself, 17 was his, he decided to take out 20, which leaves him with a -3. Okay, so that is the current account. Okay, let's get back to the FP, which is here. So we have the finance by section, where we have capital 60, 30 for Pierce, and then we have the current account for Pierce, which is from the previous T account that we did, and we have Clark with a negative. Remember, we said Pierce has a positive and Clark has a negative, and if we just quickly refer to that, 4840, 3690. Okay, and then we have the total for capital 60 plus 30, positive 4840 minus the 3690, so we're still in a positive in terms of current account balances, which is still fine. If it's in a negative, it's in a negative. It is what it is. And then we have the total for Clark, so Clark's net worth, Pierce's net worth, and the company is worth 91,150, which matches the net assets figure, and that's one way of checking if the arithmetic is correct. Okay, so that leaves us to the end of the question, and I hope you found it useful. Again, in summary, what we've looked at in this video is the income statement, following thereon appropriation, the financial position, which is all the same except for the latter part, finance by. And again, before you do this, you need to do the capital and current. Okay, so I think my next video is going to be on changes to partnerships, which involves the capital account. So what happens in a partnership, i.e. if a new partner joins, if a partner leaves, etc., those kind of changes we will be discussing. And with changes in a partnership, there are changes to the accounts, there are changes to capital, and that is a requirement of AQA that you need to understand that. So that's what my next video will be. Feel free to subscribe to the channel so you may benefit, and thanks for listening.